being a Fed governor is basically an extended job interview for the job that follows at Goldman Sachs, for instance, where they make their real money. And they don't want to jeopardize that.
The zinc supply is facing a massive deficit. Mine closures are certainly putting a major upward pressure on the best performing metal of 2016. Right now, China has temporarily shut down 26 of its zinc mines until June of 2017. Zinc inventories are at their lowest level since 2009, and the zinc fundamentals could not be any more favorable as the world is facing a worldwide supply shock. The former president of the largest gold producer in the world just left the company to join a junior mining zinc play that is currently sitting on $9 billion of zinc and rising. Learn more about this incredible opportunity at crushthestreet.com/zinc.
Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amaduri, and we got another favorite here at Crush the Street, quite possibly the favorite, John Rubino of dollarcollapse.com. He's the co-author of The Money Bubble. And as he always does, John Rubino is going to reveal some truth today. John, thanks for joining me.
Hey, Kenneth, good to talk to you again.
As always. John, in a world of negative interest rates, and as you put it, this is a paradise for gold. And I want to ask you today about the CPI index and inflation, and why the headline numbers cannot be trusted. And as we know that when we subtract real inflation from the ultra low returns in bonds, we have negative yields even here in the US. But it's all about perception. So let's just get your initial thoughts on this.
Well, yeah, it's getting harder and harder to trust all the headline numbers that the U.S. and frankly a lot of other governments are putting out, which isn't a surprise. You know, they have an agenda. They want to look good, the guys running any given economy. And the people who create the statistics work for the guys who really need to look good in order to get reelected. So it's no surprise that these numbers are massaged. And they do it in a variety of ways. You know, with, for instance, unemployment, they consider things to be jobs that most of us wouldn't really consider, you know, jobs. Like a part-time bartending gig counts just as highly as does a $250,000 a year computer programming job in government statistics. So the quality of the jobs is going down while they're reporting better and better unemployment rates. And in inflation, you've got all these statistical tricks that are used to massage the numbers that give the guys who are creating, for instance, the CPI, a huge amount of leeway to report a number that looks better than probably the experience of the average person would say that it is. And so, you know, that's to be expected. And I think we should trust our own experience rather than the numbers coming out of governments at this late stage in the devolution of what used to be capitalism and is now something really different in the developed world. So the fact that we've got negative real interest rates now, even with the government's numbers, implies that things are actually worse than they're saying, even though what they're saying is pretty bad. I mean, negative real rates are generally seen as stimulative. In other words, money is so cheap that they're basically giving it to you, they're paying you to borrow in real terms when you have negative real interest rates. And Keynesian economic theory says that should ignite a rip-roaring boom in which everybody who can possibly borrow money is borrowing it because the government is paying you to do it. And so you borrow money, you spend it, the economy grows, people get hired, they get ever higher wages, we see inflation bubble up because wages are growing, and then you've got the problem of growth that's too fast. Well, we don't have that problem at all right now anywhere in the world. And the reason for that is that we've borrowed so much money in the past that that acts as a headwind to slow down the global economy. So they've been having to cut interest rates and increase government spending and create new currency and dump it into the banking system. All, QE and NIRP and ZIRP and all the policies with the brand new acronyms that we'd never heard of a decade ago that don't seem to be working anymore. And the reason that they're not working is because we've already borrowed too much money. And after a certain point, there's really not much you can do. And we're at that point now. So you're seeing, for instance, Japan and Germany, or Japan and the European Union as a whole, grow far more slowly than they need to grow in order to slow down the increase in debt relative to GDP. So these guys are still leveraging themselves further and further. And the U.S., because our numbers are harder to figure out, it's not clear whether we're growing just a little bit and our debt is not increasing relative to GDP, or actually, we're hardly growing at all and debt is continuing to soar. I suspect the latter. I suspect that things are worse on the leveraging side than they're telling us, as well as the other statistical quirks that we talked about. So if this stuff doesn't work, go ahead. Yes.
Yeah, I was just going to add to your point there, and you can continue. But Barack Obama is poised to become the first president in U.S. history to never have a single year during his term in office when the economy grew more than 3%. And that's with the Fed being more aggressive with stimulus than we've ever seen in history. Again, only just to add to your point, continue with your thoughts there.
Yeah. Well, it shouldn't be a surprise based on the amount of debt that we've taken on in prior decades. Today's problems are not the fault of the guys in charge, but the fact that they're getting worse is the fault of the guys in charge. We started borrowing excessive amounts of money in the U.S. in the 1980s, and that was a direct result of the 1971 decision by Richard Nixon to break the final link between the world's major currencies and gold. At that point, all the major countries had effectively unlimited credit cards. They could create as much new money as they wanted to because there was no external limit, as there used to be under the gold standard, on money creation. So, of course, these guys were corrupted by that new power. And, of course, we've taken on more and more debt year after year after year. And we've reached the point now where so much of our wealth creation has to go to pay off our old debts, to pay the interest on our old debts. And so few people are willing to borrow anymore, even at low interest rates, because they've already borrowed as much as they feel like they can, that you don't get much bang for stimulus buck anymore. And that's where we are. The Obama administration came in and ran the biggest deficits in the history of the human race. No country has ever borrowed as much money year over year as we did for a stretch there post 2008 crisis. And it kept us out of a depression, but it didn't ignite a huge boom. Same thing with interest rates. We've never had interest rates this low for this long in literally human history. You can go back 5,000 years of records that are more or less available. And there's never a time when there were zero and negative interest rates around the world. And we're not booming. And see, that's got to terrify these guys, because their theory says that you do something like this and you get an equal and opposite reaction. You push interest rates down, the economy booms. And you push interest rates way down and the economy rockets. And that's not working. So their theory now, their model, is clearly flawed, but that's the only model they've got. So the next iteration of fiscal and monetary policy is going to be more of the same, apparently. You've got economists out there saying, well, zero interest rates and negative interest rates, they're kind of working, so let's push it further. Let's go further negative. And then in order to do that, we've got to get rid of cash, because you can't have dramatically negative interest rates if people can just pull their money out of the bank and put it in a vault, right? So we'll eliminate cash, and then on the fiscal side, we'll have governments ramp up spending again and run big deficits, because you know what? It's cheap. Why shouldn't they borrow if they can borrow for literally a negative interest rate? The Swiss government is running a surplus right now because its debt has a negative yield, which means people are paying them to borrow, so they're making money. And to a Keynesian economist, this is a great idea. This is a profit-making enterprise now that governments can embark on, where they borrow money and they get paid for it, and that frees up money to spend on social issues and to satisfy human needs, and et cetera, et cetera. And this leads to a situation where interest rates can never go up, right? And we're there now. We can never raise interest rates back to normal levels because it would blow up everybody's budget. If you're a government who has borrowed trillions of dollars short term, in other words, in paper that has to be rolled over continuously, if you raise interest rates, then you've got to roll all your debt over at a higher and higher rate and then pay higher and higher interest on that debt, and your budget blows up. For instance, Japan is in a place now where if their interest rates just go to U.S. levels, just up to what the U.S. Treasury has to pay to borrow, their interest costs will exceed the entire tax take of the government. In other words, they would just pay interest. They would have no money left over for old age pensions or their defense or infrastructure spending, nothing. And they're the worst case scenario, but the rest of the world is in kind of the same boat.
Wow.
So we're in a situation where we can't get out of the box that we're in, but if we stay in the box, that just means we have to borrow more and more money year after year until it all blows up.
Wow. John, so when it comes to the U.S. and, specifically the position that the U.S. is in, being such a global superpower, with the rest of the world lowering rates, what sort of dynamic does it put the global economy in when the U.S. raises them, around the world? You kind of touched on that, but, I kind of want to touch on that a little more with just the dynamic of what that sets into the global economy.
Well, other things being equal, if we raise interest rates when everybody else in the world is cutting rates, which they are, nobody else in the world is even conceiving of raising interest rates at this point, that'll make the dollar stronger relative to the other fiat currencies. And if the dollar goes up, that means U.S. multinational corporations will have more trouble selling their stuff overseas because their stuff is priced in dollars. So if the currency goes up, then the cost of their products goes up. And that means corporate profits in the U.S., which are already falling when you calculate them correctly, that is, generally accepted accounting principles. GAAP earnings are still falling for U.S. corporations. We're in an earnings recession. And they would fall further if we raise the value of the dollar. Now, stock prices are generally based, in the long run at least, on the underlying earnings of the companies that make up stock indexes. So if earnings are going down, then stock prices ought to be expected to follow them down. And that puts us in a position where we'll have an equities bear market that we might not be able to handle. There's a new phrase that's getting tossed around out there, the too big to fail stock market. And that illustrates the fact that we've leveraged ourselves to the point where even a garden variety 20% drop in equity prices might be too much for the system to handle. It might cause a cascade failure of a lot of other parts of the economy that could turn into a 1930s-style depression, or could force central banks to ramp up money creation and cause a hyperinflation. The governments of the world just don't know what would happen. So they're terrified of what used to be a normal occurrence in every 5 or 6 year equities bear market. And that's the situation that we're in now. If we raise interest rates, that, by the way, the Fed wants to raise interest rates because the banks that own the Fed, the Fed is not a government agency. It's owned by a consortium of banks, including JP Morgan Chase and Citigroup and Goldman Sachs. They want higher interest rates because rates have fallen to the point where they're not making as much money as they used to. And they're having to scale back and fire people and cut their bonuses, which they obviously don't want to do because they love those bonuses and they love having an empire like they have now. And they love being able to finance political campaigns. The banks basically control the economy in the U.S. and by extension the rest of the world. And so controlling the political system is very important to them, and they're using that power in order to get higher interest rates in the U.S., or at least to push the Fed towards higher interest rates.
Wow.
Now, the Fed is looking at both sides of this. Their bosses, the big banks, want higher interest rates, so they want to raise rates. On the other hand, they're afraid if they raise rates, they get that crisis that we just talked about. So they're very conflicted, as you can tell from what Fed governors say all the time. You've got these talking heads out here who run Fed branches saying contradictory things because they really don't know what to do. So one of them says, oh, yeah, we need to raise the inflation target from 2% to 3 or 4%. Another one says, oh, we need to raise interest rates right away, and it goes on and on. Because they have not the slightest idea what they should be doing. They know that if they do one thing, they're in trouble from one group. If they do another thing, they're in trouble from possibly another group. And they don't want to be in trouble. They don't want to preside over a 1930s-style depression or some new age kind of financial crisis that's different from anything that's come before, because they'll get blamed for it. But on the other hand, being a Fed governor is basically an extended job interview for the job that follows at Goldman Sachs, for instance, where they make their real money. And they don't want to jeopardize that because what would be the point of the government service for all these years if you're not going to cash out, right, by making millions of dollars in your eventual job with the big banks? So, it's a problem for these guys. And you got to sympathize on the one hand, but on the other hand, I would just like them to shut up, because it's really frustrating to hear these guys who are supposed to know what's going on and supposed to be the best and brightest just flail around out there saying this random stuff that really in the aggregate doesn't make any sense at all. The markets don't completely seem to get that yet, but I think they will at some point. You're seeing more and more opinion out there about how central banks have lost credibility, and as that spreads, then their words will have less meaning, and maybe the markets will start doing the opposite of what they say because they will have lost trust in them.
John, when it comes to what the Fed does, a lot of what it is to combat deflation. That was the big scares that we're going to go into a deflationary cycle. And I want to ask you about gold in that scenario. And, are there times in history where we actually saw gold go up during a deflationary period?
Yeah. Well, see, gold, in all previous financial crises, gold was money. So deflation, by definition, is the value of your money going up, right? So gold got more valuable when prices were going down and the value of currency was going up, because gold was that currency, it was the money of the countries back then. So today it's slightly different because gold is not a functioning currency. Nobody uses it to transact. But it's still a store of value, which is, if anything, the most important function of money. So there's a pretty good chance that if we tip into deflation, people would be so panicked by what they see as the inevitable central bank response, which is a massive tsunami of new currency flowing into the system. The central banks would just panic if we did start to tip into deflation. They would do the war on cash, where they make paper cash illegal and cut interest rates to negative 5% and increase government spending by trillions of dollars a year. They would do all that stuff. And so I think a lot of people would be spooked by that prospect and would choose to hide out in gold and to a lesser extent silver. So you'd see a lot of paper capital flowing into real assets like gold and silver, and that would push the price up. So yeah, I think gold does well either way, because we're in the end times for this kind of economy. The fiat currency fractional reserve world is starting to break down.
So would it really be considered deflation if people are going into gold? Because wouldn't that most likely mean that the dollar is getting weaker?
Well, no. If we have deflation, the dollar would go up.
Right.
But if presumably gold would go up more.
Okay.
So gold would go up either way, inflation or deflation. But the fiat or the main fiat currencies would behave differently in inflation or deflation.
Right.
So holding dollar cash would still be okay in a deflationary environment. It would still buy more year after year as the deflation progressed. But the fear that that engenders would probably send a lot of dollars and euros and yen flowing into gold. So gold would go up, if anything, more than the fiat currencies do in a deflationary environment. At least that's the way it's happened in the past. Gold got more valuable during the Depression. And the reason for that is that money becomes more valuable when prices are going down. So if we're treating gold as money, which we probably should and we almost certainly will in the next stage of the evolution of this economy, then you shouldn't be too worried about your gold holdings, even if we choose door number 2 and tip over into a 1930s style depression.
John, what are the threats of gold actually having its day in the sun for people that own gold?
What are the threats?
Well, and I've heard you talk about this, and basically, what are the likely scenarios for the powers that be to go after people who are owning gold and having gains in this precious metal? As gold is having its day in the sun, it might not be as good as we all think it might be because the powers might go after it.
Yeah. Well, maybe the war on cash gets extended to a war on gold, for instance, where they make it either hard or illegal to own precious metals, especially gold. In the 1930s, they made it illegal for Americans to own gold. As bizarre as that sounds now, it was a crime to have gold coins in your bank safety deposit box or buried in your backyard. It's less likely that they do that this time around because back then gold was the money of the country, and now it's just considered a commodity by most of the central bankers of the world. So they won't immediately go after gold. But if the disparity between the fiat currencies of the world, which are plunging in value, and gold and silver, which are going up relative to those currencies, becomes too extreme, which makes the governments look bad, because here you've got this old kind of money that's been around for 3,000 years that's doing way better than these new age currencies that you're managing, which means you're incompetent. It's completely possible that in that kind of a scenario, they impose some kind of a wealth tax on the owners of precious metals and other hard assets, or capital controls that make it impossible to move gold and silver from one place to another, or various other kinds of things that take some of the profits that you would otherwise have had in your precious metals and move it back to the government. And we just can't know what they're going to do, and we can't know who will do it where. Which country is going to get craziest when things really get going. And so the way you respond to that is with diversification. Normally you want to diversify between different asset classes anyhow, but in this case you want to diversify your hard assets between different geographic locations to increase the odds that as much of it as possible is protected from whatever kinds of impositions that different governments try to impose on precious metals when the time comes. And it's not necessarily just precious metals either that could be at risk here. They could come after our stock and bond portfolios in our 401ks and our IRAs, because that's where the real money is. There are multiple trillions of dollars sitting untaxed in these tax-advantaged accounts. And when governments get really desperate, they're going to start looking around for the low-hanging fruit. And forcing you to convert your IRA or your 401k into government bonds would be a really easy way for them to finance their deficit for a few years. So stuff like that is liable to happen too. And there's no way to know what the specifics are going to be, because we've never been here before. And there's no way to know which country is going to do what, because we've never been here before. So, diversification is the only way to approach this, because there's really no other solution. I mean, you can't not own hard assets in this kind of environment, because that's the best option right now in terms of things that should go up in value and or hold their value over time. But you also can't be certain that those things are going to be unprotected from rapacious governments when the time comes. So you have to just spread it around as much as you can. You can buy a Swiss insurance policy, for instance, as a way to move some money overseas. You can have gold bullion stored in Hong Kong or Singapore, which presumably are going to be less subject to U.S. pressure when the time comes. You could buy Latin American real estate. A Costa Rican beachfront condo would be a nice thing to have in any circumstance. And maybe Costa Rica won't suffer the way the developed world suffers when these fiat currencies start to spin out of control. So you can do things like that if you have the capital, and that increases your odds that some of your capital survives when the time comes.
Yeah. John, just to illustrate how bad the economy has been on the middle class, and for that matter, the African American community under an African American president. We got the number of blacks on food stamps jumping 58% under Obama, home ownership dropping almost 10%, median income falling, a large youth unemployment, and I only bring that up to actually bring up the disparity between what has happened over the course of the last few years between the rich and the middle class and otherwise poor in this new economy. And I guess I want to ask you, do you suspect that the ultra rich during this next collapse, the coming collapse, to profit even that much more, because we know that a large percentage of the income gains have gone to the top 1%. And I'm curious if you think that it's going to be different this time around, or will it be more of the same, and the percentage of wealth in this world going towards the ultra 1%, capitalizing on the next big financial crisis?
Well, first of all, huge disparities between rich and poor are exactly what you should expect in a fiat currency, fractional reserve banking world. In other words, what we did in 1971 when Nixon took us off the gold standard inevitably led to this point, because once governments have a printing press, they can create as much new money as they want to, which they inevitably will in order to win each new election cycle, right? The incumbent party is going to pursue easy monetary policy heading into every election. That money, the way we're set up now, flows into the big banks, which get to use it first and make money off of it and become extremely powerful. And then they help their favorite clients with cheap loans and stuff like that. So the rich get richer in that kind of an environment. And that's exactly what has happened. And we're at the point now where the disparities are starting to cause political problems for the 1%. We're seeing fringe parties, formerly fringe parties, who are not business as usual, let's stay the course kinds of people, draw more and more voter interest around the world. And so I think that's the limiting factor in this process, that the guys in charge can't do what they've been doing for very much longer, or their people are going to be voted out of office and new people are going to come in. Donald Trump and Bernie Sanders are both in favor of reimposing Glass-Steagall, which is the law passed after the Great Depression that broke up the big banks and divided them into different groups, rather than today's financial supermarkets, and so you're seeing stuff like that become politically palatable now. And if it goes on much longer, then we'll see more Brexit type votes in Europe, for instance. Right now, if France had a referendum on whether to stay in the EU or not, they would vote to leave. And other European countries are in the same boat. So we'll see stuff like that. Or in the next presidential election in the U.S., somebody like Donald Trump will not just get nominated, but will actually win. We'll see President Bernie Sanders or somebody like that. Or the Libertarian Party will take so many votes that it'll destabilize this political system or something. We'll see political change everywhere with the at least partial goal of taking from the rich and giving back to the people who have been plundered by the rich. And so the process will end in that way. If it doesn't end in a gigantic financial crisis that that lops 70% off the value of most stock portfolios and high-end real estate portfolios, which is another way of taking from the rich, right? You know, the value of all these financial assets and trophy properties goes way down, then the rich get much less rich, and that's coming too. You know, so one of these things is going to happen to stop this process, because it can't go on forever. You know, the 1% can't take 100% of the wealth from the 99%. And so, since we're about as far along on this process as we've ever gone, at least in recent history, then it's reasonable to expect the process to be self-limiting at some point in the not-too-distant future. And one way or another, you know, politics or economics.
Interesting
a change
point.
happened.
Yeah, so I mean, really, you know, what we saw in 2008 with the ultra 1% benefiting, you know, throughout the last few years, the quote-unquote recovery, you don't see that necessarily happening this time around, because eventually it's self-limiting. I like that word you said.
Yeah, Kenneth, it didn't have to happen in 2008, actually. Basically, the big banks went to George W. Bush, and they told him, we're going to have martial law in a couple of days if you don't bail us out with trillions of taxpayer dollars. And Bush caved. But they were bluffing. You know, if the big banks just disappeared, that would still leave us with the same number of factories, hospitals, and computer plants and farmland that we had the day before. You know, we wouldn't lose a lot of real wealth. And in a banker's mind, at least in a big banker's mind, the banks are the economy. So they weren't lying. They actually believed that we were on the verge of a financial crisis that would literally wipe out the economy. But it didn't have to go that way. You know, Iceland, for instance, when they had their financial crisis about the same time, they protected bank depositors, and then they put the bankers in jail, you know, and they let some of their banks fail. And it worked out just fine for them. So we could have done the same thing. So in other words, in 2008, we could have stopped this process in its tracks. And, you know, the 1% would have lost a lot of money in financial assets and in high-end real estate. And the value of yachts would have gone way down. And so they would have gotten less rich relative to the rest of the people in the country. And income and wealth disparities would have compressed a bit. We didn't do that. We chose to try to prolong the process. And we got away with it. You know, we had another 6 or 7 years of basically business as usual after that. But the next time around, the numbers are so huge. You know, the world borrowed $57 new trillion in the 5 years following the 2008-2009 crisis, which is some multiple of the size of the U.S. banking system. That's a lot of money, a lot of new money coming on top of a system that was already dangerously over-leveraged. So this next time around, because the numbers are so much bigger, the crisis is going to be commensurately more serious and harder to handle. And so there's a good chance that this is the end of the road. And, you know, who knows what comes next, because that becomes a political process, you know, a political debate among people who, on one hand, believe that this was a crisis of capitalism and we need a stronger central government in order to prevent it from happening again, and other people who see it as a crisis of government, and we need a smaller government and more individual freedom in order to prevent it from happening again. You know, that'll be the debate, and it's not clear who wins that debate at all.
Well, everyone, you're not going to hear it like that on CNBC. John Rubino of DollarCollapse.com. John, any closing words or anything you want to let our audience know about DollarCollapse.com and new developments?
Well, you know, same old at DollarCollapse.com. It's just a, you know, continuously updated site that covers a lot of this stuff. But I would like to say that, you know, this is basically an investment thesis, all this gloom and doomy stuff. And the positive side of the story is that in times of crisis, there are a lot of opportunities. So if we position ourselves in the right way for what's coming, we can make a lot of money. You know, our personal stories can be very positive, even as the global financial system's story becomes really negative for a while. And that should be what we're thinking about. You know, what what do we have to do in order to protect our families from what's coming? And precious metals, of course, as we've talked about, is one way to do that. And the mining stocks, the companies that dig gold and silver out of the ground are another, a riskier way, but potentially a lot more profitable way. So be paying attention to the mining stocks. If they correct from here, we've got a really nice entry point for adding to our positions in the high-quality miners. And so people should be paying attention to that going forward.
I love it. All right, John, thanks for coming on the show with me today, and we'll talk soon.
Thanks. Talk to you soon, Kenneth.